So welcome, everyone. Excited today to have an incredible guest panel here to speak about a topic close to all of our hearts as part of the startup ecosystem. Practical ways to unlock financial freedom along the journey as a startup founder or employee. Now, startups are evaluated at future values, but how to solve for financial freedom today? If you're a startup employee with equity, you're pretty confident in the company you're a part of building, and your equity will eventually pay off. Must you wait to access that capital? We'll explore equity in general, equity in Australia, and how to leverage the liquidity you have to diversify your overall risk. One important thing to mention is this is not financial advice, and before making any financial decisions, please make sure you speak with your accountant or financial advisor. Now, as a founder, you know you're solving a big problem. The future is bright, and investors have even valued your company into the millions. Amazing. Yet, if you've ever inquired about securing a mortgage, you know that banks struggle to understand loss-making, high-growth businesses. There are people that get you. For instance, what if we told you there's a pathway to homeownership for founders now? I know. All right. A couple of quick housekeeping tips. We will answer questions that are submitted via the Q&A box, not the chat. Please don't use the chat box. We will not be answering questions there. We will answer questions for the last 15 minutes of the webinar today. So make sure you get them in, and we look forward to reaching out to those questions. We will send out the recording to everyone that has registered for the webinar. So no need to ask if you registered. Clearly you're here, and you will definitely receive a recording of the webinar tomorrow. Amazing. Now, we go to the next slide. I'd love to take the opportunity to welcome our guest today. First of all, we have James Bowe, the co-founder of OwnHome, whose mission is to turn renters into homeowners. OwnHome does this by helping customers overcome the deposit hurdle. And get this, startup founders welcome. We also have Jason Atkins, the founder of Cake Equity and the man behind the machine that delivers ESOP allocation, capital raising, and all things that give equity superpowers. Matt Allen will be joining us shortly as the founder of Tractor Ventures and curator of financial alternatives. He'll share his views and expertise on options to access future capital today and diversification. And last, but certainly not least, Rob Lamb, head of talent at SquarePeg, previously leading talent for other global tech giants such as Apple and Uber. From this experience, Rob brings dynamic perspective on options and the versatility they can offer founders and employees. Amazing. Now, most audience members will more than likely be familiar with the companies represented on this panel. But for those of you that are not, can I ask each of the amazing founders on the panel this evening to give us a quick 1-2 minute idea of behind your business? What is your mission? We'll go ahead and start with James.
Thanks, Keri. Well, OwnHome's mission is to turn renters into homeowners, and we're doing that through delivering a new path to home ownership, one that allows you to save for your home while you live in it. I guess the skinny on OwnHome is that we're backed by the Commonwealth Bank and SquarePeg, amongst others. And what we know about first homeowners in Australia today is that the majority of successful first homeowners make it onto the property ladder with the direct financial support of the bank of mum and dad. And we know that that's really an understandable consequence of just how eye-watering deposits have become. And we also know that startup founders and business owners more broadly typically go through some lean years in pursuit of building their businesses and usually set back their savings goals in pursuit of that as they're bootstrapping or in their earlier stages. And even when they're humming, they'll find that they might be persona non grata to banks, while their employees might breeze through in securing a home loan. And so we're here to really support folks who are lacking in access to that intergenerational wealth transfer that's typically become the deciding factor in making it onto the property ladder. Thanks, Keri.
Awesome. Thanks so much, James. Jason, would you like to go next?
Yeah, for sure. So, Cake is really passionate about equity. It can be really locked up and hard to use. So we've simplified and streamlined equity plans and capital raises so startups can use their equity better to build their company. And one thing we like to do is help promote and create liquidity opportunities. Again, liquidity can be really difficult in startup land, but we're looking to try and develop these avenues as much as we can. And so we'll highlight awesome solutions like tonight, that are available to founders and employees that match, the way startups currently work, but also how we can perhaps redesign things a little bit, to make these things more achievable. So yeah, happy to be here.
Awesome. Thanks so much, Jason. Rob, over to you.
Hey, thanks, Keri. So look, I'll be brief. So Square Peg, on the quantitative side, I suppose we're a global investment firm. So we've got 4 offices, a little over $3 billion in assets under management. And that for us is across VC, an opportunities fund, as well as a global listed equities fund. I think what separates us a little bit on the quantitative side is we've delivered material returns to a lot of our investors. So just over $600 million returned. And we've done that through supporting, we're very fortunate. We've done that through supporting amazing founders. And let's be clear. So we've done that since 2012, a little more than 50 companies. So Fiverr, Canva, Rocked, Finexcel, Airwallex, et cetera. So, but look, coming back to the folks of this call, the qualitative side, I think is really, really important. We exist to, quite simply, to empower exceptional founders. That's why we exist. And we're really founded based on this idea that tech will change the world. I think we're all pretty much aligned on that one. And our founders will be the drivers of that change. So that's it. Our focus is on helping founders succeed. So hence why I'm on this call.
Brilliant. Thanks so much, Rob. And last but certainly not least, welcome, Matt. Over to you.
Thanks, Keri. Hi, everybody. I'm Matt, one of the co-founders and CEO of Tractor Ventures. I've been a founder 4 times. I've run equity, I've run VC-backed companies. I've also been a quasi-VC or an angel investor. And we started Tractor to help founders with alternate methods to capital. So we do revenue-based financing, which is lending against, treating your recurring revenue as an asset and lending against it, which means that as a founder, you retain more of the company that you've put in the hard work to build.
Brilliant. Thanks so much, Matt. Well, time to get started tonight. So before we get started, we're going to drop some polls just to see who we have on the line with us tonight, who's in the audience, and then we'll share those results with you as well. So if everyone could take a moment to answer the poll, that would be awesome.
Not going to let me vote. Hey, guys. It's okay.
No, panelists are not allowed to vote.
Panelists can't vote. We are excluded. We don't want to skew the results, Jason.
We know where you guys are. Actually, should we share with the audience where all of us are? If they're sharing with us now where they are?
I'm in Melbourne.
Sydney.
Gold Coast.
Sydney.
In Sydney.
Yeah. Very cool. Awesome. So we should be just about wrapped up and we can go ahead and share those results. There you go. Mostly from New South Wales, mostly founders on the line. And from an array of funding stages. Awesome. Well, we have an incredible program for this evening. First, we'll start by demystifying startup equity with some Equity 101 and dive into the equity characteristics we most commonly see here in Australia. We'll then dive into the philosophy of diversifying wealth and the tools available to do that. Some even say that de-risking your personal life can provide more professional freedom. After this, you may just agree. All right, let's get this started. So the first question we have this evening is for you, Rob. For those joining us today who are new to options, could you provide us a quick 101 on the functionality and maybe some quick facts and some quick tips?
Yeah, happy to. I'll go through this reasonably quick. And then for everybody on the call, if you have questions, and there's always questions in this space, as a team, we can certainly answer a lot of that stuff afterwards. So look, effectively, if a founder offers an employee an option, it gives that employee ownership interest in the company, right? So specifically, that's in shares of stock. In the clearest sense, each option is a contract, giving that employee the right to buy and sell it at a specific price. So now it's really important to call out that an employee specifically should know that they're not obligated to buy the option. It's simply the opportunity to. So I'll run through a super quick example. And again, I know we have people on this call who will be super well versed in this, so I'll be brief. But a good way to think about this is if you were offered a role, you're offered a new role, and your founder offers you options, you would lay out some kind of ownership plan. So you would come to understand, and hopefully they would communicate, this is how our stock option plan or ESOP works. So for sake of example, the plan may explain you receive 100 shares after your vesting period of 4 years. Some key things to know is that most plans will have what's called a cliff. This may mean that you have to complete a year of service in that company, but cliffs vary. In the case of this example, your equity's vesting over a period of 4 years. So you would get a quarter of your options, 25 of them, if you're awarded 100 at the end of that first year. Now keep in mind, not every option plan is the same, and rules on actions like vesting and withdrawals really vary. So it's important if you're an employee, and it's also important if you're a founder to be really aware of these things, to sort of maximize the benefit. So let's be clear, this is a benefit. This is a really cool thing that you get offered as a part of being part of really special and interesting companies. But also, if you don't understand how they work, you can really miss out on a big extra bonus as well. So that's the really basic overview of options.
Amazing. Thank you so much. I know they can be quite complicated, so that was a great job simplifying it into a couple of minutes. Jason, as the ESOP master, do you have anything to add as far as, I'm sure there's lots to add.
Yeah, look, I think we won't make this mega ESOP-y. We're here to sort of talk about the value of equity, but I think, in a startup, as a founder, you want to try and build a culture of ownership as much as you can. You want to think about, increasing the value of equity over time, obviously, and that goes for the founders, but the employees as well. So, the more you can, articulate that value, progression and the plan, and build that into the company, the better. I think, for the employees out there thinking about, are there any liquidity events potentially coming in this company? Some companies might have it built into their culture and some might not. And, companies that do have it built in, arguably would be, a better place to be because, you can actually take some of that equity, that option plan that you're earning over time and be able to, liquidate some or all of that over time, which is obviously, a big advantage. So that's something I'd be sort of, having a look for. A couple of things we talked about the other day, Matt, might be worth bringing up. So the exercise period is just a little funny one that you might not normally hear about. And some companies, if you leave, they'll make you exercise straight away and some won't. So something to keep an eye out there. What that means is, you can keep your options as an option. You don't have to make the payment to the company straight away if you leave, and you can leave them as options, which is quite often better. One that's a little bit, I just thought of before this, and I'm going to bring it up because possibly the worst thing that can happen as an employee is that your company doesn't actually implement the scheme correctly, and they give you a big tax bill. So if they don't do the ATO sort of valuation correctly, it just doesn't hurt to ask how they've set that up. Avoid yourself getting into a bit of tax pain early on. But in general, obviously, we're super supportive of ESOPs. They're great for wealth generation for the team, and they're great for founders to help them engage and retain and motivate their team. And yeah, so looking forward to chatting more about it with how we can work it into the OwnHome space as well, and turn it into home ownership. It's pretty cool stuff.
Absolutely. Are there any trends in particular that you've noticed across the Australian ecosystem?
Besides the fact that they're very common now, that's probably the biggest one. I think going back 5 years, no one kind of really knew much about them. They were very difficult to implement. The ones that were implemented, were really busted. We've had some really good success stories as well. The other day, highlighting a few, Atlassian's the big one. More recently, safety culture. I don't know if the guys want to talk through, a couple of these great success stories. I think all of us seeing these material events come through and change, so many people's lives. I think, you just can't, you can't unsee that, can you? It's pretty big.
Absolutely.
I think it was just the other day that we were talking about the fact that the Sydney house price seemed to move on the back of the Atlassian sort of IPO, and just how significant that was for so many people in Sydney. And so it's great to but I think we're in the earliest innings of some of those success stories flowing through. And so there's whispers of it, and maybe people have, the third degree connection that's achieved that sort of life-changing outcome.
It used to be, you get offered an ESOP offer, and then you go talk to your family, and your uncle says, "Oh, ESOPs are bad, you're going to have a tax problem." And, we just didn't have that relevancy and that recency, for people to really engage with, which has, changed considerably in the last few years. And look, it's exploding globally as well. Cake's now riding like a global trend. So all over the world, employees now are sort of seeing equity as a norm when it comes to remuneration. And so, it's a strong trend that founders really need to get around. And you want to make sure you're making the most of it as well, which is why, thinking about having little exits and helping your employees really understand that, okay, I might be getting 100,000, I might be getting, for argument's sake, $20,000 worth of equity, but does that really mean anything to them or not? Well, if you can sort of draw more or less a straight line between there and potentially, turning some of that equity into a home, which for many youngsters is out of reach, I think as a founder, then you're really able to capitalize on the implementation of the scheme.
Great. Did anyone else want to comment on any interesting liquidity events, or happy to continue?
I might chime in. So, liquidity generally comes when demand for the shares in the company that you own, or options, exceeds the supply. Excuse me. So in the life cycle of the startup, as they raise money, it's likely that if things are going well, there's more shareholders who want to become part of that company than shares that the founders want to issue. And that's a really interesting thing, where if the ESOP has been structured properly, there's a chance that an employee will actually be able to, as Jason said, sell down some of those options to these new investors and realize some of their gains. It's always a choice from the founder. Quite often, the longer you leave these things, the more valuable they get. And just as a couple of terms that we just touched on there that may not be very clear. When you have options in a company as an employee, there'll be a price that you have to buy them at. And hopefully the price you sell them at is greater than the price you buy them at. And usually the buy and the sell happen at the same time. So you don't actually have to pony up any money. It's usually when somebody comes along and says, "Hey, this company is doing very well. I would like to buy your options off you." At which point you turn them into a share for $1 and you sell them for $10 and you get the difference. it's really clear that it's really important to remind, when you get an ESOP, you might have $100,000 worth of ESOP, that when you eventually get access to turn these into money that you can then go and buy stuff with, it's the delta between the price that you have to buy them at and the price that you sell them at, and the delta is what you get to keep yourself. So it's not, you don't get them for free, but you get them for usually, if structured correctly, which most ESOPs are now, a very, very cheap price compared to the price of the company when you even joined. So, my employees at Tractor have a strike price, which is the buy price on their employee share plans, which is really, really low compared to the actual price that shares are being bought at today. So you can do some mental maths in your head and go, oh, the shares today are 6, 7, 8 times more than what mine are. And as an employee or even as a founder, like ESOP is actually used for founders for the board to encourage founders to sort of keep going as well. So the maths you do in your head is like, ooh, the last time someone bought some shares in the company, they were at $10, and my ESOP has a strike price of $1. Therefore, the $100,000 I have is actually worth $1 million now. And then the ability to turn that into $1 million is a function of, as I said, times in the point in the company when people want to buy into the company and you've got an asset that you can sell them, which is really exciting. Just a couple of anecdotes that might be interesting. We mentioned the LLC ones. I've had several portfolio companies of mine that have done what's called a secondary transaction, where the founders and myself as an early investor was able to sell a portion of my shares to new incoming shareholders. And as founders, it was life-changing. They went from a decent salary to multi-millionaires overnight, and allowed them to go and buy their house outright for cash, which doesn't happen all the time. But the implication that even Keri mentioned on the way in is that when you have a place to live and you've secured that place to live, it generally translates into running a better business. My strong thesis is that any founder that is running a business that has a house to live in and it's theirs, they run a better business. It's almost a one-to-one correlation, whether you like it or not. If you can look at the bottom of Maslow's hierarchy of needs and say shelter is solved problem for me, which is generally the expensive one. All the other ones down the bottom are kind of solvable problems, and shelter's the expensive one. If you can solve for that,
except for lettuce now, but
except for lettuce, houses and lettuce is expensive. You can solve for that, then what I've seen is like a material uptick in the growth of these businesses, because the founders are no longer feel like they have all their eggs in one basket and their entire net wealth is wound up in this one thing. And as founders and even as early employees, we all know how wobbly these businesses are. They might sound great from the outside, but there's shit going down all the time. And to de-risk it a little bit allows you, in my mind, to run a better business. So, part of taking, and it's funny because it feels like it's not the right thought process. It feels like I should leave all my things in this business because it's going to be a unicorn or a rocket. But actually, by slightly taking some de-risking along over time, I strongly believe that if you do that as a founder, you'll build a better business by slowly taking some money off the table whenever the opportunity arises.
Yeah, and I can probably add some value on the back of that from Matt from a VC perspective. I think, and I can only speak from a square peg perspective, and we may be a little different to a lot of VCs, but we've historically had the view, additive to what Matt shared, that founders operate best when they're not totally stressed out about their own finances, like paying mortgages, et cetera. So, we feel it's entirely reasonable for founders to sell secondaries as their businesses scale. At the same time, you try to balance it, and maybe this is a little bit of advice for founders, but try to balance this with, we try to be a fund that anchors a little more than many, I think, to the founding team. So we want to believe that the founder's in it for the long term too. So you also don't want to have too many secondaries. It can be a little, suboptimal, but it's really a balance. But we bias from making sure that the founders feel they've de-risked themselves through the process. Selling secondaries, the only thing I'd add is selling a secondary super early, like seed stage, probably isn't common and not super reasonable. But holistically, this is about best thing for the founder from a livelihood perspective, which ultimately helps them run a better business. So totally agree with that.
Yep. The only one thing I'll add is I have seen founders sell too much secondary and they get distracted. So I say there's a scale on secondary. So to be clear to the audience, a primary raise is when the company issues new shares to new investors and that money goes into the company so the company can be used to grow. A secondary transaction is when an existing shareholder sells some of their shares to a new shareholder and the money goes to the old shareholder and it doesn't touch the company. So really important to note that secondary is when an individual gets the money from the increase in those shares, and a primary is when the company gets it so they can put it to hire new people and grow things. But yeah, the scale is de-risking on one end and distracting on the other. What you'll find is that if you're a founder and you're in that really awesome spot where you might be raising a round and you might be raising, and as Rob said, it's unlikely to be an early round, it's more likely to be a Series A or above. So say you're raising $10 million and you've got $12 million worth of people that would really love to get into your business, but you only want to issue $10 million worth of new shares. That extra $2 million might be able to come back out to the founders and say, if there's two founders, they sell a little bit each and take $1 million each. And, that sounds like a lot of money, but for really good founders, like they're not going to stop running their business. And in fact, that $1 million, you chuck it against the mortgage or you go buy your first house or you do something with it. And what you're then doing, you're bearing in mind at that point in time, that $1 million probably represents 5% of the amount of shares they have in the company. So most of their wealth is still wound up in this company, and they're still highly incentivized to go off and build a big business. But they know that $1 million is now secured over there, and they can do whatever they want with it. And one of the things that I always talk about is secondaries, as I just explained. They're actually usually for the partner of the founder, because the founder signed up for this shit and the partner and their families didn't. And they're the ones that if you can say, look, listen, I keep telling you this company's worth tens of millions, if not hundreds of millions of dollars, and your partner's going, yeah, big deal, I'm still renting a shitty house. And you can start solving that problem along the way. What it does, it releases the pressure of the founder to look after their family, which they're quite often, everybody wants to do that. And it allows them to sort of buy some focus back onto really driving a really good company. So, to be clear, the only time really the opportunity arises is if you're building a great company. So the premise of all this, the underlying thesis here is that you build a great company, they've got people that are excited by and want to be a shareholder, then you can, and I'm doing this at Tractor at the moment, I'm selling some secondary because the amount of people that want in exceeds the amount of people that the amount of the new shares you want to issue. Therefore, it can sort of take some pressure off the founders.
Would you mind if I jump in and just ask a little bit about the employee side? Love all that. It's such good clarity, very practical. Appreciate that. I don't have that much experience with employee exits. You hear about some of the big ones. Obviously, we're very passionate about it at Cake. We know in Australia, there's sort of a 3-year window. A lot of you would be aware of that. Some of you might not. So, if you issue options to your team, they can't be sold within 3 years unless they leave. So just do be aware of that time frame, and you can still work that into your ownership culture. But once that 3 years is up, certainly advantageous to be able to get those employees access to some secondary, again, only under the circumstances that Matt has earmarked. If you've got a great company and there's excess demand, on the investor side, anyone have experience, with this? Is it kicking around the same time? What's going on in that space? Matt, you said you've organized it for your team.
Yeah, I can talk to that. So I've got, I've been the beneficiary of secondaries as an early investor, but the first employee actually got liquidity at the same time I did.
We've just had a few of our guys tick over 3 years, so it's certainly something we'd be looking to work towards ASAP. So
interesting enough, it totally comes down to you, Jace. You're the founder, right?
They're in good hands then.
Exactly.
No pressure.
So as an employee, a question you can ask the founder is, assuming that I've been here long enough and I've had enough value to vest my shares, if there's the opportunity to sell some of these in a round, like what's your attitude towards it? Because a lot of it is actually dictated by the founders or the board or a combination thereof. So like this, and it's interesting because some of our, without naming names, some of our most prestigious startups have been quite dictated heavily by their founders, and about which employees can create liquidity. And interestingly enough, it's more of a concern for ex-employees sometimes, right? So a founder may optimize for creating liquidity for people that are still with the company because it actually benefits the company. Where if you've got options that they're still yours, but you're not there anymore, they may deprioritize that sometimes.
I can see that.
Just because, there's a finite, like that. Yeah, the amount of capital available to create a liquidity event may be finite, and they're going to pick and choose, and they're going to sort by, I don't know, impact maybe of the company, which is probably likely to be early employees, like the longer you've been there, maybe some early investors or whatever the case may be, and they'll sort of pick and choose it, which is kind of interesting as a leverage point.
I normally try and I would normally advocate for reasonably I suppose fair and transparent equity plans, but I know when these things happen, I guess the best decisions need to be made for the company too, and that might be driving these decisions. But
well, I think that kind of feeds into question that Toby from the audience put forward, which is around like how the funding Armageddon at the moment is potentially impacting the likelihood of secondaries over the next year or two, and then does this ever occur outside of fundraising events? And to me, I think Matt summed it up really well, which is it really just fundamentally comes down to supply and demand. And we're seeing that supply and demand shift on the primary capital raising side of things. And more often than not, secondaries do tend to be that overflow of excess demand is usually the enabler of that sort of liquidity event on the journey towards IPO. I think the great news is that we've seen some traction of secondaries in the Australian market, but we're a long way behind other markets like the US. But at least that precedent has been set, and I think we've got like maturing custodians in terms of like sophisticated VCs in Australia that are eager to create de-risking for founders and employees, but somewhere between, somewhere short of a distracting level of, liquidity. But that'd be my sort of. So in short, I think the Armageddon is absolutely going to flow through to impact secondaries over the next year or two, would be my view. But great businesses will continue to get funded, and there will and secondary opportunities will be created. But it might create more of those sort of tensions around trade-offs that were alluded to there around who are the populations that get prioritized and what's the purpose of that secondary. Is it to retain and incentivize, talent that's still in the business?
There's also there's also a dedicated secondary fund in Australia now called Second Quarter, run by a really experienced investor called Ian Beattie, and backed by a couple of the really big family offices and one of the Aconex founders that sold for 1.2 billion. And Aconex is a really good example of founders who de-risked over time. They were able to buy the house for their family. They were able to take enough money off the table to pay for school fees so that, the pressure inside home allowed them to build a really, really big business. To answer your question, there is a way, and we're doing it at Tractor now, to get some words put into a shareholders agreement, which does require shareholders to sign off on it. But once they're there, it allows the founders to create liquidity if there's a buyer, without having to run through the entire shareholder base and offer it to everybody. And they're usually done within small thresholds. So it could be like someone can sell 5% of their position, every year without them having to offer it to everybody, which creates this sort of really interesting mechanism where if you found somebody who wanted to buy your shares off of you, and you sort of found them, you come along to the founder and say, hey, I've got someone who wants to buy 5% of my shares off me. Can we make that happen, please? And then it's up to the founder's discretion or potentially the board. And that's that's a sign of maturity. Like as James was saying, it's a sign of a maturing ecosystem when what is traditionally an illiquid asset, as shares in a startup are generally an illiquid asset, as opposed to buying shares on the ASX or the NASDAQ where you can sell them to anybody. There's a free-flowing market. There's usually a market that doesn't really exist. So if someone's going to create some liquidity for you, as in buy your shares off you, then a couple of things usually happen. They're usually done at a discount. They're usually sold at less than the value that the last round was, generally, for a couple of reasons. One, it's an illiquid asset. So if you want to sell some, you're probably going to have to incentivize the person to buy them off them. And two, usually the options that an employee or even a founder has is right at the bottom of the stack of equity. So the people, usually when you're selling shares in a startup, the people who buy them last are the first ones to get their money back. So the ones that the employees and the founder get it right at the bottom. So there's a little bit of a discount applied to those things. So if the startup you're part of just did a round and the shares are worth $100 each, and you've got 100 of them or 1,000 of them, it's likely that if someone was going to buy them off you today, they're probably going to pay a little bit less than $100, because it's not really an asset you can sell to any person willy-nilly. And it's just important to bear that in mind when you're doing the mental maths about how much ownership you have on your shares right now.
Yeah.
Thanks so much, Matt. So we've talked a lot about exiting or secondaries and what to do with these shares or options. And let's bring it back to the beginning. This question's for you, Rob. What would you say are the most important pillars for founders to get right when setting up their incentive plans with employees to ensure that on the back end there's a smooth transition to these different options that we've spoken about?
Yeah, I've got a few thoughts on that, and I know this, like, their whole panel will have fantastic input on this. So I'll try to be brief and then let other people share, because I think there's a lot to be added. So this sounds silly, but Matt just spoke to this as well. I think first you've got to really be clear on what you're hoping to achieve with the incentive. So, for example, a lot of founders want to really inspire their team to act like owners, right? They want to drive very specific behaviors in their people, like working harder and smarter, because they're effectively owners in the business, right? So incentivize thinking differently. I think following on, or the second sort of thing that comes to mind is think hard about how you operationalize your share option plan. Like things like, how long is your cliff? Like, do people have to wait 6 months, 12 months, a year? How often you vest? Are you going to vest monthly, quarterly, biannually? And how you create opportunities for liquidity for your people. The thinking here has really high impact. If I have to wait a year to get my first tranche of shares, and then I only vest every year, within that time, if I have a couple of really bad days, or if I get approached by a recruiter that's like, hey, there's this other awesome role for you, the vesting cycle can help retain, can also help push away. So I'm very likely to wait for another month to get some more shares if I love my company. I'm not going to wait a year, so I'm more likely to jump. So think about that. There's different outcomes. In the same vein, options are also valuable as a retention tool for your existing people, right? So remember, your team is doing great, meaningful, impactful work. Incentivizing them with additional options, it's a good way to show recognition. And this is one that I've seen in Australia, particularly, it's missed, where there's not, a lot of founders don't have refresh models. There's lots of reasons for that, but I would really think deeply about the real tangible impact it has on your people. Coming back to the basics, keep it simple. If your ESOP is super complicated, it's a detractor. If employees can't even understand how it works, it's going to have the opposite impact. It will not retain. People will just throw their hands up. So be clear with your team that while, I guess maybe this is my final point, be super clear with your team that there's this huge potential upside to build wealth, to really have an impact on people's career. And one of the panelists shared this. It's this opportunity to build intergenerational wealth. There's this huge potential upside, but you got to be clear with people. It's possible that options or companies also decrease in value. So I think those are the sort of 5 things that I would throw out there. Certainly there's more, but those are ones that can have a real impact. But keen to have feedback on what other people think as well.
I'll just add, so when I was at Amazon, they gave us shares in a slightly different format of options, but it's we won't nitpick and confuse the issue, but their vesting was heavily weighted to the last 2 out of the 4 years. So they vested a small amount, 5% of your initial vest in month 13, and then another 15% in month 25, and then 20% every 6 months for 2 years. So and I got to 2 years and 6 months, and very much on purpose, because that 20% of the initial grant, which happened, like, gave me sort of a 6-month thing where I'm like, I'm going to work really hard until then, and then I'm going to make a decision whether I stay another 6 months. So to Rob's point, it's really important that people understand that there's this period of time where, like, it's coming or going, and as a founder, I want it to happen as frequently as possible, so that they, things are going well. One of the questions is that Armageddon question, and liquidity events, is that, look, you may have a share that was has a buy price or a strike price at $3, and things aren't going very well with the company, which means the company share price has gone down rather than up. The terminology there is like they're not in the money anymore. They're out of the money. You wouldn't exercise it because the share's worth $2 and your option is worth $3. What usually happens in that case is founders will then go and grant a whole bunch more at a much lower share price to sort of counteract them all, hoping that the company value goes up over time. This happens all the time at Amazon. I was there only during a period where it went up, not down. But as it goes down, they end up going, oh shit, we need to give people a whole bunch more shares at this much lower price to counterbalance the swinging price. So it is, as an employee, it is important to understand the delta between, and you should be able to ask your founder, what's our current share price? Like, what was our last round share price? Is a question you should be able to confidently ask to know that you can do the maths on your options. Really important.
Yeah.
I think it's good for founders to give regular updates to employees with an option plan, the same as they would an investor. Perhaps not exactly the same, because there's a different level of sophistication, but really important. We do it in our all hands. We sort of have the team update. So where was our last round at? What's our next round likely to be at? Like right now, we've just done an update, hey, the world changed. This is where everybody's ESOP is, because think about now as a founder, a lot of your team might be really scared about what the company's worth, what their ESOP's worth. So even get on the front foot with it now and take that fear away. Even if it isn't like an amazing outcome, you're probably better off taking the fear away, giving them clarity, showing where you're going next year, ideally, in an ideal case. As James said, doesn't always go up, but I think, being really clear with your team about what the share price is, or what's happening is pretty important. I think there's a nice driver in this engagement and retention piece that we were able to, I guess, benefit from at Cake, just speaking sort of from experience where, for argument's sake, someone might get $10,000 worth of options in the first year, and they're getting $10,000 per year. So it's a 4-year grant. In the 3rd and 4th year, if the company has, for argument's sake, tripled in value, instead of getting $10,000 in the 3rd year, they're getting $30,000 in that year, which is a really significant increase to, what they would be getting from an alternative employer, potentially, because they go back to, getting the first year grant again of 10,000. So it's a really nice driver, financial driver, to retain your team. Of course, companies don't always go up, and so it's not always there, but certainly if you've been able to have a couple of up rounds, it's a really nice way to create value.
Brilliant. That's some really great advice for founders. I know we have many on the line tonight, so I'm sure they appreciate all the great advice. And we've briefly touched on the importance of owning your own home as a founder, and also realize that this is a really tricky ask since the banks kind of put you in the too hard basket. Now, James, as a startup founder yourself, you've built OwnHome to provide other founders and business owners with the opportunity to access homeownership and all of the security that comes with it. Knowing that these individuals are not serviceable by traditional banks, how exactly are you able to service these founders and business owners?
Yeah, it's a really good question. I mean, OwnHome, the role of OwnHome on the founder journey, I see, is somewhere on your journey towards that life-changing liquidity event. And before you have that deposit or that ability to buy that home outright, you might be eager to at least secure the certainty that comes with owning your own home, the ability to sort of invest in and make renovations to your property, and experience the fruits of being a homeowner. And OwnHome is able to, I guess, deliver on that by taking away that need for the deposit, but pulling forward all of those elements of being a homeowner. I crunched the numbers on our customer base today. I mean, we've supported folks in the Cake family, folks in the Tractor Ventures family. 15% of our customers are founders or CEOs of businesses, which is well and truly overrepresented versus the general population. 35%.
That's awesome, mate.
What's that?
That's so good. I'm really stoked to hear that. That's absolutely fantastic.
Yeah, and for us, it's like we know that it's not playing at a different end of the risk spectrum. I mean, there's no one better to back than founders and CEOs of businesses. And the sad reality is that banks take a pretty blunt view of, if the entity is a loss-making entity, you as a director may find it impossible to access a mortgage. But ironically, your employees will find it incredibly easy to access bank finance.
Kills me.
Yeah,
I've taken calls from the bank confirming that I'm employing someone. And I pay them a certain amount, and like, cool, is this for the mortgage? Yep. I'm like, cool, can I have one? And like, no, why not? Because like you may tomorrow you may not have this business. I'm like, yeah, but I employ that person, and I might have to fire them. They're like, that's not how it works. I'm like, exactly how it works.
Exactly. And so we're really, I guess, delighted that for that period that you may find yourself temporarily persona non grata, you're at least able to pull forward that experience of being a homeowner through the OwnHome path to homeownership. And really delighted, I guess, to be supporting so many folks across the Australian tech ecosystem on their journey to homeownership. But no, I like that so many more innovations are required. Like, selfishly, Tim and I often joke that OwnHome was a very elaborate means of getting Tim into his own home. So Tim, my co-founder, is an OwnHome customer. And so it really came, that Maslow's hierarchy really resonates in that when we sort of reflected on the largest challenges in our lives, it was that uncertain path to becoming a homeowner, hashtag first world problems. But really, I guess, delighted to be doing our small part of creating something that's practical in supporting what is a really substantial aspiration for so many people. And I know that lots of the wealth creation discussion today has trended towards that aspiration to at least start solving really just fundamentally parts of that Maslow's hierarchy in time.
Awesome.
Here's an
James,
interesting
we should probably point out that you don't have to have an ESOP to work with OwnHome. For those of you that aren't 100%, that's not the normal way. I presume everybody knows it. I just wanted to make that clear. I think this was an opportunity for Cake and OwnHome to, I guess, be part of the discussion. Right now, I'm thinking, was that me that wedged that in there? I'm sorry if that was the case, but I think we should really, help people understand, I guess, exactly how they would go about, OwnHome and what how it all works, mate.
Maybe very
understand
briefly, what I'll say is that OwnHome is really assessing you not on do you have an ESOP and other forms of wealth, but actually is fundamentally, are you capable of making the monthly payments of a mortgage? That's the fundamental question. And we all know, there's the meme of like, don't mind me, can't get approved for a $1,500 a month mortgage. I'll just go back to paying $2,000 a month on rent. And so we know that there's so many folks that are more than capable of servicing a mortgage, but just need time to save up towards that deposit. And so our assessment is 100% focused on income. It's just a nice sort of cherry on top for you as the individual, either the founder or the employee, to know that there's the prospect of sort of potentially that windfall gain. But if that never comes to fruition, all the while with OwnHome, you're independently saving that deposit towards the home. And so for us, they're like notionally fantastic people to back, but that's more from like a qualitative view on the drive and determination and sort of income trajectory and status that you have.
The upfront costs are significantly lower, aren't they? So
yeah, you don't need deposit. Yeah, interesting enough, the people inside the Tractor family that are OwnHome clients, one of them actually had some ESOP in a startup they worked at, and then that startup did a big raise, and they were able to liquidate some of that ESOP. Yeah. And they use that ESOP to pay the small upfront fees of OwnHome, which is not a deposit, nowhere near a deposit, and allow them to sort of get on the train. Because again, serviceability was never a problem to people working in tech, but ponying up 20% of a $1 million property is hard for anyone, right? It's hard to come with 200 grand worth of free flowing cash for anyone, no matter how rich you are, I think. I mean, maybe not no matter, but for normal people, that's hard to do.
Yeah. Well, I'm glad it did come full circle. So you weren't wrong, Jason, that you saw.
Really, that's awesome. Yeah.
There you go. And James, how much? So I know it's not a full deposit on $1 million property, but instead of the kind of traditional pathway, what would OwnHome, what would it look like to move into your own home?
Yeah, so the upfront cost of OwnHome is 3% of the value of the property. So that's less than stamp duty, which is something that most people often forget, which is 4% of the value of the property. So 3% to start your journey to home ownership is the upfront cost, which is still, of course, in Sydney property, or Gold Coast or Brisbane, it's tens of thousands of dollars, such is the nature of the challenge of housing affordability here in Australia. Yeah.
In place of hundreds of thousands of dollars, though. So
that's right.
And maybe an appropriate question that we have in the chat. If you have questions, drop them in the Q&A. But it's how do you assess income for a startup if the startup isn't making a profit?
Yeah. So business income, if it's is difficult to assess, and for us, we're fundamentally focused on making sure that you have a really clear and certain path to being able to finance that home purchase, and that will ultimately involve taking out a mortgage. So if it's pure business income, that is going to be difficult for OwnHome to assess. But if you're PAYG as a director of a loss-making entity and you're loss-making, but you're able to pay yourself a salary because you've raised money, then that's a much more straightforward proposition. So follow up, director being paid a wage, it's assessing the wage. But yeah, setting aside the loss of that business itself.
Brilliant. Thank you. So if a director is being paid a wage, they will assess the wage, but ignore the loss in the company. Same.
That's right. Yeah.
Yep.
Like I'm dramatically simplifying that. Like not all businesses are made alike, but in some, if you're a high growth tech business that's making a loss in pursuit of like some fantastic outcomes.
Doing any refinancing, or is it all first home buyers? Asking for a friend.
It's all owner occupiers. There are folks who have previously owned a home and then dropped off the property ladder and then have found it race away from them. So not strictly first homeowners, but it's owner occupiers is what I'd call out there. Yeah.
Very cool. So we have a few questions left for the Q&A session that relate to our previous discussion on dilution and future share options. So I will ask, and whomever would like to answer the question. So how does one factor in dilution when looking at their current and future share option values, particularly if you know that the company plans to go through additional raises in the future? Thank you, Kara.
I'll take that one. So if you usually in a startup you get a certain value of options at a certain strike price, so you can kind of figure out what the price is. And your share price is your share price, even though they may be issuing more shares. So, you know, the intent of all of us, including us founders, is that the relative amount of the company goes down over time that we own. So if there was 1,000 shares and you owned 10 of them, you owned 1%. And then as the raises go through, then they're going to be issuing more shares. So you don't own 1%, you might own 0.8% after the next round. But hopefully the share price has gone up greater than the dilution has gone down. So you do need to keep an eye on it. So there's two questions that you can ask the founder, which is, how many shares are on offer in a fully diluted way, which includes all the ESOP plus any other options that may be around for founders. How many shares are there, and what's the share price? Because then you can figure out, you can reverse engineer what your ESOP's worth.
Maybe check for safes.
Is that right?
Maybe check for safes and notes as well, because you know sometimes it's a bit hard to see how much of that is there and what the dilution might be.
So fully diluted is the term you're looking for to ask your founder. Don't be surprised if they don't have an answer for you, because depending on how they've raised money, it may be easier. It may be a difficult question to answer very specifically. They may give you some ranges. It may be between X and Y. And that's just because the way we raise money as founders is not always that we issue more shares, we tell ASIC about it, and then those shares have a price and you can reverse engineer it back. Sometimes we raise money on things that may not have a direct correlation to share prices yet, but they will in the future. But just to bring it back, the answer is how many shares, what's a fully diluted cap table, how many shares are on the fully diluted cap table, and what is the share price of the last round, are the kind of conversations, things you want to have, so you can figure out where it all sits.
Yeah, specifically like when you hear convertible notes, like those are going to add some complexity into simply calculating the price.
Yep.
Great. And so a question from Paul is, how are intermediate liquidity events enabled for founders and employees before a liquidity exit? Are they only enabled on a raise, or are there other ways?
I can grab that one again. A liquidity event generally goes hand in hand with a raise, in the fact that there's new shareholders coming in. There's a share price that's been set today, and again, if the supply of new shares, if the demand for new shares exceeds the supply for new shares, then potentially you can go back in and you can start buying some old shares. Second quarter is that it quite often in more of a scale-up company, not in an early company, but in the sort of series B and above. If second quarter get involved, then they're able to provide liquidity between rounds at the behest of the founder. So a shareholder can come to the founder and say, "Hey, I want to sell something," and second quarter have the ability to buy those shares in between liquidity events with their special formula that is not 100% of the price of the last share price. And that's because they're doing you a favor by creating some liquidity for you where there is none. So they're usually sold at a slight discount to the face value of them.
Yeah, that, and they often may rank differently to shares. So maybe that's what you just said, Matt, but ordinary shares versus preference shares.
Correct.
Like Series A preference shares.
This is kind of an interesting question from Pierre. So between secondaries and paying yourself an executive salary, are there rules or customs in which should come first?
I'm happy to jump in again. Most good investors want you to pay yourself properly, right? So like you running your business and paying yourself under market is actually like the easiest, most tax effective way for you to mitigate risk, or for them to mitigate risk of you, is to pay yourself properly. So quite often what will happen is investors, say Square Peg, come along, drop tens of millions of dollars in your bank account because you've just done a raise. They'll make sure that you are on a decent salary, right? Because that's the easiest way. Like that, you don't have to argue about share prices. You don't have to talk about secondaries. There's no signaling to the market that you're selling anything. It's just like, just pay yourself a proper salary, please, right? And that's fine. The challenge you've got there is that if you're still running a loss-making company, the banks treat you like a leper. So a nice fat salary will allow James to do his work, but it won't solve for a traditional lending mechanism, but it will solve for OwnHome. In fact, a nice fat salary makes James's job really easy because the serviceability is nice. And really what they're looking at is, can you pay the payments for this mortgage plus a little bit more, versus do you have a deposit and can you pay these these payments? So like step one, pay yourself a raise, pay yourself a salary, always pay yourself a salary first. It's just the least complicated way to extract some money for yourself out of the company, which, to be clear, as a exec in the company, you're probably going to be paid the least out of your exec team for quite a long time, but it doesn't mean that you're so hungry that you're starving and that it's making your life hell, because you're not the best exec you can be. And it is step one, pay yourself a decent salary.
Yeah. Thanks, Matt. And thanks for summarizing OwnHome. Proposition so well there. I think there's a good question here around safe notes, because I did just bring that up with convertible notes, and but particularly used by early employees. I don't necessarily know the question about the early employees, but the role of them broadly, convertibles and safes, is when it's difficult to achieve price discovery. And so like this year, you're going to see a lot more convertible notes by mature companies, because investors aren't necessarily certain of what is the appropriate, priced round to do. Are we trending down? Are we trending up? And so I don't want to draw a line in the sand with a price round, but actually the most appropriate mechanism is to do a convertible note, which converts at the next fundraising round, which might be at a different environment that's got greater clarity one way or the other. And really, safe notes are just the same, serve the same function, which is it's not appropriate to do a priced round for this seed company, because there's so much up in the air around whether or not they're going to hit the milestones you need to believe for them to be a valuable business. And so let's keep it simple and do a safe, and then we'll leave it to the next round, by which point we should have a bunch of proof points that make it appropriate to do a priced round. But in terms of the implications for early employees, I think the one thing I'd flag there was just around, it doesn't, and Matt said this, it doesn't therefore immediately show up on the share register. So it doesn't like immediately appear in the denominator and impact the share price. So there's going to be some overhang, so to speak. Yeah.
Thank you, James. I think you're probably best placed to answer Ryan's question as well. I'll go ahead and read it out for the others on the call. How does OwnHome work with the current First Home Super Saver scheme, and can the scheme still be used in combination with OwnHome?
Yeah, in short, all of the incentives and support that exists from government for first home buyers remain for OwnHome customers, so long as the price that you're buying that property at qualifies for that first home saver scheme, or so the point at which you become a first homeowner is the point at which you exercise the option to buy the property from OwnHome. So that's when you would be sort of deploying or relying on those, like for instance, like the first home super saver, to put that to work. So you could sort of run that in the background and then use those funds to also exercise the option to buy from OwnHome very specifically.
Brilliant. Amazing, James. Well, we have cleared all of the questions. This has been such an awesome webinar full of such great information. Just to wrap up, everyone, so everyone will receive a recording of the webinar from this evening tomorrow. And if you would like to reach out to Cake, you know where to find them. Clearly trusted by over 3,000 companies worldwide and growing very quickly. Also for OwnHome. So we are turning renters into homeowners, the new pathway to homeownership backed by the Commonwealth Bank. So we go to the next slide. We do have a QR code. If you want to scan the QR code, that will take you directly to the OwnHome website. You can find out your buying power in less than 3 minutes. It's free and doesn't leave a tick on your credit. So thank you so much, everyone, and we will see you next time. Have a great night.
Thanks, everyone.
Thanks to all of our
everyone.
panelists.
Thanks, everybody.
Thank you.
Really appreciate it.